Good afternoon, everyone. This is Henry Gambell with SimplerTrading.com, and in tonight's free video, I want to share a couple of ways to think about Apple as we head into the August expiration. So, as we know with Apple, and we really don't even have to look at a chart, but a quick summary, we had a really good run into earnings. We had a very significant pop higher on the actual earnings report, trading up into the 210 area, give or take. And now for Friday, we're here 7 calendar days prior to the monthly expiration. We're right back at 200. So without even looking at a chart, but knowing a little bit of the backstory, I'm kind of thinking that you've got emotion on both sides of it, because you've got people that are still stuck from 210, you've got buyers from down at 190, and they all kind of meet in this middle indecision zone that's a big psychological area of 200. Now, it does not have to happen this way, but there are plenty of times that for monthly expiration, you just kind of see some of these names chop around these areas, and then when you get into that actual moment of Friday's expiration, then they're awfully close to one of these big psychological values. So, as I think about trying to trade that, the first thing that comes to mind is evaluating the short straddle. You look at this just to see, do I think that this name is going to stay within this type of a move, or do I think it's going to exceed it? Because, of course, you could always take the other side of this trade. If you think Apple is going to move big, well, then you'd look to be buying the straddle. Around expirations, I generally prefer selling them. Alright, this would say that you're basically betting that Apple is going to stay within a $6.35 range, but you're taking on a large amount of risk to do it. That's one way of trading it, but the second is going to be to cut that risk down and just come out here and buy some wings. So by buying this protection, you now turn the trade into an iron butterfly, which has the benefits of the short straddle of working the decay and just selling premium, looking for choppy, indecisive action. But you can do it with a little bit more protection. And in such volatile times, I think that probably makes sense for most traders, and it's also going to chew up a lot less buying power than if you were doing the naked straddle. Now, not to get too deep into this, but because I think they are very helpful things to learn, if you look at this and kind of like it, but maybe you're more bullish, or maybe you're more bearish, then an unbalanced butterfly is a beautiful trade to look at. This would be the third and fourth ways that I might consider this. So let's just say, for the sake of argument, that you're more bullish. Well, then you would look at doing an unbalanced butterfly that utilizes the $200 short put option. We'll use Thinkorswim to configure that because it does a good job of automatically placing our strikes. I usually like them a little bit wider. Let's just make sure that these trades would in fact go for a credit. And if you set something like this up, it's a really unique trade, because at a 23-cent credit, it may seem somewhat insignificant, but you have to understand that, like say you do it for that 25-cent credit, the most you could make is $525. There's a lot more than maybe what meets the eye, and the benefit of this strategy is that it works very well should Apple pin and close at 200 on Friday's session. It also works very well if Apple explodes higher. So say that we end up finding bigger support and maybe more shorts get squeezed next week. Well, then this trade will still make you money. If you'd prefer to look at the inverse of that and say, I want to be a little bit more cautious, and if the markets roll over, I want to do the same thing, well, then you just configure the call side. So this utilizes the short $200 call. Same thing. You could do it 2.5 wide, though I think you get a little bit more bang for your buck and a higher probability of success if you widen out the wings. So something like the 195 and the 205, and that trade goes for a very healthy credit as well. So those are 4 ways to think about trading Apple with chop around 200. You can customize it a little bit further to give yourself no risk to the upside, or take the opposing view and set it up with no risk to the downside. I will probably do the neutral spread, but it's important to know all of these so you can kind of take which one fits your point of view, and also so you can adjust as the week progresses if you need to. So I hope that's helpful and gives you some good food for thought as we get ready to trade the August expiration. Y'all have a good weekend, and we'll see you at the next free video.